This week on the Encrypted Economy, I have Donna Redel on the show. My intro gives broad outlines of her deep experience, and she's so involved in the crypto space, both in terms of angel investing and in terms of education and organizing symposia. It's really amazing the breadth of how many people she touches and how much she's involved in. I just simply can't do it justice. But in this episode, we talk about how she comes from the angel investing background and how she adapted to apply it to disruptive technologies like crypto. She talks about the possibilities for security tokens. She talks about her involvement in a LAO, which is a legally autonomous organization, and how they are investing in NFTs, non-fungible tokens. She was the chairman of the board of the Commodities Exchange, and we spoke about how commodities markets insure against loss and contrast that with investments in crypto today. And at the end, I really wanted to understand what she was doing with both the Fordham School of Law and business, because that's where the students are pursuing their postgraduate work. And I wanted to understand what they're looking at and what they're focusing on as they approach this space. This is a very fascinating episode that covers so many different topics. With that, I'm excited to bring you this episode with Donna Redel. Welcome to the Encrypted Economy, where we look at the business of, regulation, and security for all things encrypted, digital assets, blockchain technology, privacy, and smart contracts. Hope you'll join us while we explore these forces that are shaping the economy. Hi, so this is Eric Hess with the Encrypted Economy. Very excited to have Donna Redel join the show today. Welcome, Donna.
Pleased to be here. Thank you so much for inviting me.
So Donna has quite a career that I'm not even going to be able to do justice to, but managing director of the World Economic Forum at one time, the first woman to chair a U.S. exchange, the Commodity Exchange, former CTO and CIO for both the international and derivatives divisions of Prudential, advisor and investor focusing on financial technology, blockchain, and emerging technologies, a co-chair, co-founder of the Blockchain Committee, board member of New York Angels. She teaches at the Fordham Business School. I'm almost out of breath, but you've had a great career, and maybe you can tell us a little bit more about your background, fill in the blanks, but it's exciting to have you on the show.
Thank you so much. Yes. So, I think you kind of outlined things. And, sometimes when I look at where I've been, it doesn't seem linear at all. It doesn't seem calculated or what should I do in my next 5-year plan. And that's probably because most of the things kind of arrived without a lot of planning, and yet they all kind of go together. They have a connectivity, they have a thread that goes through them. And the atmospheres were very different. Yes, for sure. The trading floor at 5 World Trade Center, which had all the exchanges in New York that were commodity exchanges there, is supremely different than the serene World Economic Forum looking out on Lake Geneva. So yes, I would say that was quite different.
So before diving into some of your experiences in the crypto blockchain startup space, I like to ask my guests for a personal event that helped shape their values, their worldview before diving into it.
I think, one of them for sure was growing up in a home in which both parents had been refugees from World War II. So I would say that was very much present in the home, the fact that they didn't want to live somewhere where the escape was a bridge, because my father had to leave Belgium and the only way out was a bridge. And my mother had gone from Romania and had to go to Paris. And of course, they didn't have the internet or anything like that. And people didn't know that the Germans were going to be arriving in Paris, and took her family, she was a little girl, quite some time to end up in the United States. So I think that the notion that the world can change and it can change quickly is one that I've lived with. And to appreciate what you have and the freedoms that are there and the responsibilities that come with it are ever present, I think, in my life.
Yeah, and certainly it seems in the past few years, the world has continued to change rapidly, perhaps even in an accelerating pace, particularly as you start to look at the rise of crypto and blockchain. So your work with the New York Angels is a good place to start. You've looked at the startup community that's not in the blockchain or crypto space, and you've also had experience with investments in token offerings, and just would like to get your perspective on some critical contrast between the two experiences as an angel investor.
So first of all, New York Angel is composed of about 130 individuals that come together to do due diligence, to bring their networks to the entrepreneurs. And we really are there to build great companies with great entrepreneurs. We invest across all verticals. So in 2017, we started, it was about 2 or 3 workshops on what was going on in blockchain, what was going on in the token offerings, et cetera. And that gave, from there was sufficient interest to start a blockchain committee, for furthering our education on an ongoing basis, and also for trying to have the opportunity to invest in deals. I would say that it's been and continues to be very challenging for us to invest in blockchain startups, whether those are token startups or other startups, because one, we didn't do tokens. We take equity positions, or we would do a convertible note. And so the whole ICO phenomenon, or nightmare, whichever you want to say, was not something that we were interested in. It was interesting for us to observe, but from the onset, enough of us thought that this was not a good idea. And it was not a good idea for many reasons. And many of the strict kind of training that we have as angels, you could see what was lacking in ICOs. You didn't have continuing incentives, at least in most of them. You didn't have continuing incentives for the founder. You didn't have lockups for the founder and for the advisors. All of these are really good best practices. The white papers were sketchy. There wasn't a lot of discussion about what you were going to do with the funds, the kind of people that were there, et cetera. So there were a lot of warnings to us that these kinds of projects, though 1 or 2 of them may turn out great, they were ones for us to avoid. And then, of course, after 2018, there was a big decline in the prices of crypto. And so therefore, there was a decline in the number of projects. And then things became much more specialized. And as some of the companies started to give equity, there was a lot of demand. And oftentimes the demand and the commitment outpace the way in which we do due diligence or the timeframes that we have. So we're still looking, we're still working on it. And we look forward to being able to work with other venture firms or angel companies or blockchain funds to be able to invest in crypto-based companies.
So do you think it's a reflection of just maybe it takes a different pace, a different set of parameters to be an angel investor? I mean, certainly there's venture funds that have adapted to this, but from an angel perspective or an angel network perspective, do you think there's an evolution that has to occur, or what do you think has to occur? Or do you think it's just not well suited for the collective angel marketplace?
I think it's very well suited for types of investors. And those types of investors tend to have a very deep vertical in blockchain and crypto. And they tend to know most of the people in the industry. They've invested in many things, so they get shown a lot of deals. That's not to say that it isn't competitive for them, but we invest across all verticals. And sometimes by the time it gets to us, it's very near the end of the allocation. And it would have to be a very quick due diligence. And there is something about many VCs and other groups. They feel that their own due diligence, their own data rooms are somewhat proprietary. And I totally understand that. They've done a lot of work. And just to share it with someone at the end, especially if you have a fund, they often want to share it with their LPs because deals are so hard to get into and so scarce. So I think that, it's totally understandable what's happened. I personally have been able to invest in all kinds of crypto deals, not as the number I would have liked to have, for example, but sometimes I get lucky and somebody calls me and it's earlier in the process and they're willing to take a commitment of a smaller amount.
Right. And it involves maybe less diligence and more trust, right?
That involves less diligence and more trust, but I understand maybe perhaps a little bit more than some of the just general angels and New York Angels or other places about the vertical. And I know some of the people quite well. They have a methodology. And even though on some fintech deals or others, they would tend to be supportive of a deal that I was leading, that doesn't mean that they're not going to do their due diligence. And I'm really happy that they do because they ask fantastic questions. They have unbelievable backgrounds. And when we do invest, we bring so much to the table in terms of network and understanding, et cetera. So, I think that time will evolve and there'll be more and more deals that they will look for different kinds of investors along the way. And just, we're waiting. We wait patiently and we look all the time and see what happens.
So in a shortened due diligence or a modified due diligence, like for your own personal investment, you're not with New York Angels, what do you find yourself turning to? What do you look at first in sort of evaluating any opportunity, obviously beyond the person who's presenting it, or even some just core financials that underlie the project? What questions do you find yourself asking and emphasizing that are distinct from what you might in a non-crypto or blockchain related investment?
Well, I just want to underscore how important the individual on the team is. It doesn't matter whether it's crypto. And also in crypto, I would even give a little bit more underscoring of the team and the entrepreneur. It's very, very important. I also, look a little bit about what are the terms. I don't do safes in general. New York Angels doesn't do safes, which might be another reason that we don't get into a lot of deals, because we get shown a safe and that's what's going to be, where we generally would say no. I look at the terms of the deals. I also look at the sector, because teaching and being around other people in the blockchain community, I have the opportunity to see what's going on and what the trends are. The trends change very, very quickly. I can gauge a little bit more where the trajectory of the company might be. Is it a company that we think will be a bigger protocol, or it's one that makes a lot of sense and someone might buy it because it's a good way to enhance another company's audience or portfolio or something like that. And usually I look at who the other investors are, because that can give me some confidence and I can also talk to them. So I think there's a number of things that you do. I think any numbers, in terms of financial numbers, we've learned enough in investing to discount many of them, because, anything can happen. And I think that one of the most important things is when you talk to the team and you say, well, what if X happens, that they have some good answers to that they are not dogmatic about what they think is going to happen instead of what could happen. Because as we know, you need to be flexible. Who would have known that there would be a pandemic and companies would have to severely, alter a lot of their plans or have opportunities, God forbid, because of the pandemic. But it did give a big push to businesses that might have taken 2 or 3 years to really have the audience that they have today.
And when you're looking at these projects, how do you frame out your investment horizon in terms of time? In your typical startup, I'm looking at an exit, but in the crypto / blockchain space, it's not as obviously distinct, or is it?
It is for me, because I don't think about the tokens, because I think about investing in the equity of the company. And so, again, you have the same analysis, which is where would the exit be? Who might want to buy it? How would the company grow? And the tokens I think of as a potential dividend that may or may not happen. And so if I get all fixated on the token, then I'm fixated on the trading, and then you're not an investor, then you're a trader and you're thinking about short term. And in the end of the day, you're not investing really in a project and a team and a protocol. You're investing in some tokens that you plan to sell pretty quickly.
I think I share that view. When you look at an investment, how much does the regulatory uncertainty in the U.S. play into it? How do you accommodate that?
Well, yeah, I think it's an important aspect, which is why I look more at the company than the token. But, that doesn't change that the regulatory environment is an important factor. For example, security tokens. I'm an investor in Securitized. I think it's a great company. Has the SEC relaxed some of the kind of tension points there that are around in security tokens? Have we approved enough ATSs? No. So I think that influences greatly the trajectory of growth of the company, but it doesn't mean that they can't grow in other countries. So I think that it still goes back again to the same thing, which is what are the opportunities within that space? I do think that, for example, GameStop, for all that happened there, is a big push for security tokens, because if you knew where your shares were, it would have been very, very helpful in the GameStop. So everything that happened there is what the crypto world's been talking about for some time, which is the DTCC, its slowness, its two-day trading, settlement, et cetera. So I think that the time might come. Sometimes it takes a little longer than you had anticipated, but it'll be there.
Yeah, there's a lot of gaming in terms of available supply during the two-day settlement cycle. I don't know to what extent you've invested in decentralized governance projects. Have you looked at those?
Yeah, I'm a member of Flamingo. So that's a decentralized organization. It's actually it's a little bit different than some of the other ones because there's only accredited investors there. But we operate in a way that's consistent with the DAO. We vote, we have a Discord channel, we chat about all different things that we're going to invest in. We buy NFTs. So I was very anxious to learn about this space. And I thought the best way for me to learn about it was to be immersed in it more than just being on Clubhouse or chatting with people, but was to, make an investment. It's the same size as, I would normally do on New York Angels. Of course, the amount that it is now is much larger because ETH went up. And I think it's super interesting to learn about not only the art, but the land and the music and all kinds of NFTs. It doesn't mean I'm 100% convinced on what the trajectory would be long term. Not to say that it's short term, it's not astonishing, but yeah, I think that counts as a decentralized organization.
So I'm going to go back to explain for some of the listeners. Can you explain the distinction between a DAO and a LAO?
Okay, so a DAO is a decentralized autonomous organization. The most famous DAO was in the SEC report, the DAO report, and it was to vote on, not very dissimilar from what we do at New York Angels, for people to come together, all kinds of people, to vote on whether or not they would support an investment in a startup. So I'm used to that kind of thing. But the SEC took a point of view and issued a report in July of 2017 saying that the way in which the tokens were issued is in contravention for the securities regulation. And Eric will correct me if I say anything that's not true. He's a practicing attorney. So they objected to that, and they laid out what is called the Howey test. And what the crypto community was a bit surprised about it, not lawyers in the crypto community for the most part, because this was a test done in 1946 in a Supreme Court decision. And so that case, which is fantastic to teach because it has not only a Supreme Court case, but it also has a fork and it has a hack. It has all kinds of great things going on. So at the end of the day, the DAO fell apart and it wouldn't have been able to proceed anyway with the SEC. So Open Law decided that they were going to try and create a version of a DAO, and just it was called a legally autonomous organization, but still operating in the same context, except for everybody that joined had to pass the SEC's accredited investor test. And they've just recently, I think it's approved, but the intention was to open up a little bit who would be able to be there, because right now it's just a financial test, and they've expanded it to include, under the proposed rules, that it would also include certain kinds of knowledgeable people as well, irrespective if they had the litmus test of money and assets to their name or to their family name, however, which way we were counting it. So that's what it is. And we pooled together our money. Each one of us submitted ETH, and that wallet in which we submitted the ETH is the whitelisted wallet, and that's the one we vote on. So when there's a proposal, we use our wallet. That means that we're the investor, and we vote accordingly if we want to buy X or Y, or we want to modify something in that way.
And then switching over to NFTs or non-fungible tokens, I think most people are certainly getting a wind of what NFTs are. They have the same notoriety at this point as the ICOs of 2017, although different in nature for sure. And there's certainly different buckets of NFTs, but which ones do you think are more intriguing? I mean, obviously the third tier celebrities, I'm sure those aren't the ones you're investing in, but where do you find?
Yeah, when I started at Flamingo, which, it seems like it was forever ago, there was a little less hype on the NFTs. So we've done a combination of different kinds of NFTs, meaning in different verticals. So we did art. And I really thought that was what we were going to do. In the beginning, I didn't realize that there were all other kinds of NFTs, meaning land, et cetera. And so I was really, for the most part, because I have also a good affinity to art and I enjoy art and and I think I know maybe a little, and I wanted to learn more, which I knew nothing about, was with the NFT art and how it works and et cetera. I do think that there's been a lot of explosion in terms of the number of marketplaces that there are. I don't know in complete total analysis of each one of them if they're the same for the artists, i.e., are the contracts the same? In the smart contracts, do they carry over from one to another? Can you get your royalties irrespective of where your collector might sell? And also, to be candid, even though I'm a collector, I have not read the code nor had somebody decipher the code on the collector side to see what my limitations may be, because I'm not spending the money that people are spending in, personally, I'm not spending that kind of money to buy NFTs. The DAO is, or Flamingo is, but, there are people there that understand code very well. So I think that sometimes you don't know exactly what you're getting when you're buying an NFT. And I think that there are different marketplaces, and I'll bring up Top Shot because I know people are super interested in the NBA, et cetera. A great thing that's going on there, and they've sold in a very short period of time something like 230 million worth of, and this will drop today, of cards. Well, the people there are buying a moment, but they're buying the moment to see in that closed marketplace. It's not on the Ethereum blockchain. It's on a different blockchain. I believe it's called Flow. And you can't take your moment out of there and do something else with it. So it's in there. I'm not just saying that they're not going to have fantastic ideas within this closed environment of what you can do with it. They're just really in their beta testing, and bravo to them on how well it's going. But people should understand that it is a different concept than, hi, I bought a song and I can do these 7 things with it. So I do think that people are going to learn, and sometimes they learn the hard way, that you have restrictions. And there's been some complaining about Top Shot in that they are limiting how much you can withdraw in funds, your own dollars in your wallet. Now, I doubt it's a complete regulatory thing. It could be a regulatory thing if it was under, let's say, 10,000 or 3,500, but to limit it to 1,000 is difficult on some people, and some people have made quite an investment in there and would like to take some of their money out, and it's in there. So that's an unintended consequence of success, but sometimes, things like that happen.
You almost have to wonder with Top Shots, they are certainly, in terms of promoting what they're selling, they've really put their chin out. At some point in the NFT space, there are going to be consumer protection issues raised. You're already seeing it in the trading card marketplaces. It's a very intriguing space. There's the art component and how it advances the interests of artists, whether songs or musical artists or painters. Then there's the lower tier celebrities. There's the land purchases. You mentioned Decentraland. The virtual land sales are quite high. And then there's a whole host of other potential applications down the road.
I do think for artists, or let's just say sports teams or whatever, but I'll just leave it to artists for a moment, because I know that the sports teams are governed by different kind of intellectual property and a union and all kinds of things like that. But for individual artists, for them to be able to handle their own label, for them to be able to eliminate some of the intermediaries, for them to be able to have a more rapid settlement where they get their money faster, cleaner, et cetera, is fantastic. So I think that it's all new, and therefore it's an experiment. And so people that go and buy NFTs, they should just understand it's an experiment. I would like to see more transparency on pricing. I'd like for the things in the, let's just say, visual art market that have been criticized for quite some time, I think that we should improve upon them in the digital space, not only for the artists, but for the collectors and for the reporting of pricing across ways. Now we're going to have to do that because there's some intention to be able to use these NFTs in decentralized finance. And in order for them to be collateral, we'll have to have some really good pricing. And there will be coming a time where they don't trade as rapidly. And then, we don't know what the pricing is when you don't have constant trade. So it would be the last trade, and that would be great if it was 4 million. But what if the next trade is 1 million? So I think we still have to flush out what's going on. It's incredibly exciting. And just people have to be careful.
Yeah, and the cross royalty point is something that I'm very interested in. I know that Rarible, which is an art NFT platform, if you buy something off of Rarible and you set a royalty, that royalty will be supported by OpenSea, which is another platform. So there is, at least between those two, there is that compatibility as terms of royalty. But then, if you really want to allow people to own and have possession of the collectible, the question is, if there is a royalty involved, then there has to be some way to actually make sure that it doesn't trade out of the community that does support the royalty, or else, it really breaks down the intent of the creator.
Yeah, and there are other things. I mean, intellectual property law is important here. Ultimately, we're going to see the money laundering come in here. Yep. And at the end of the Trump administration, there was a bill that was passed in the Congress that dealt with antiquities and art, in terms of they've been long known to be shielding money from tax, from money laundering, and from countries where we're not supposed to trade with, i.e. Iran and others. So I think that that's going to spill over into the NFT world, because that area is something that in general in crypto, both FinCEN and Janet Yellen have indicated that that's their concern about crypto, more than is this going to be a competitive currency. They're more concerned with that aspect than the other. So I think that it's early days. People need to be careful, because we have to make sure that we harmonize the way in which the regulations are adhered to, because this is a global market.
Yeah, for sure.
And also, people have to remember they have to pay taxes.
Yeah, well, that's...
You buy something for 100 and you sell it for 200, you have to pay taxes on the 100 gained. And I think if people forget about that, but unfortunately, that is actually one of the biggest trip-ups for many people along the way in all different kinds of businesses. They either forget on purpose, or they forget because they forgot. And
or they're not getting statements.
They're not getting statements. They're not going to be getting statements here, especially since they're going from exchange marketplace to a marketplace.
Right, yeah. Right. That's going to become an area that's going to get quite specialized over time, because it's going to have to. Yeah. The IRS is wise to it, for sure. Wanted to shift gears a bit back to DeFi projects, loss reserves. So one of the things that we talk about in the regulatory context is if somebody says, well, we're a DAO and we're so decentralized that we're not a securities. And fundamentally, it comes back to the regulators, whether it's the CFTC or the SEC. And it's like, well, who's liable? Who's really liable if things unravel? And I know like Aave has an insurance fund that's like 30%, which is great. And I wonder what your thoughts are on the direction of protecting against that kind of liability. Is it these pooled insurance funds? It's hard to sort of mandate a single organization to backstop everything, but I would just wonder what your thoughts are on that.
So, I come from the commodities exchange background, and for all of the negative that's put on centralization, the clearinghouse in the commodities world has really done a great job. I mean, they stand in for every buyer and every seller, and there are just not defaults that happen. If something happens to a clearing member, the other clearing members step in, and there's a guarantee fund that comes into play when the loss needs to be covered. And then there's even pro rata way in which you re-up the guarantee fund if the guarantee fund was depleted from something that happened. So I think there might be ways to copy a centralized system in decentralized land. But I do think you need some backstops, because otherwise, if there's a big drawdowns and people lose money, they lose confidence. And so anything that can be done to increase confidence, whether it be insurance or some quasi-guarantee fund or something in that way, that as it gets bigger and more users, and especially retail, when more retail comes in, then the regulators, where they've been pretty quiet at the moment, will look in to say, hey, what's happening here? Especially given that yields are very low, and in DeFi, the yields are higher. So it could be very attractive to people that are looking for yield, that are on a fixed income and would like to get a few more percentages each year. So I think that will be important. And I do think that one of the reasons that everybody's stressing decentralized besides that is a very good and important theme in crypto, is that we have not had clarity from at least the US regulator about what is sufficiently decentralized. So everybody wants to call themselves decentralized, even if it means maybe we should not have the safeguards that would be best for the protocol. I mean, it might be fantastic for the protocol, but they're a little nervous, and rightly so, that they could fall into the, well, is that sufficiently decentralized, which is a term that we're still grappling with as to what that means. And so I think hopefully under Gensler, the new or almost new SEC chairman, I'm assuming he's going to get approved, we could get some clarity on some of the things that are open in the very long, not often completely detailed framework that the SEC did 2 years ago already, and give people guidance. It will give, the more clarity we have, the more that the protocols can blossom, because they'll be dealing more with facts than lawyers telling them where the bright lines and some that aren't bright at all.
Right. And I think you're referring to the digital asset framework. That is, there's something like 32 criteria to potentially apply, and it's not always clear which one to apply when. It's an interesting framework, too, because in many ways, the SEC dismisses one of the elements of the Howey test completely, the common enterprise component of it in the digital asset framework. And it remains to be seen whether that actually be supported, given that in federal courts, the courts have looked to both the horizontal and vertical tests to determine common enterprise. So by the SEC's digital asset framework, it's assumed.
Yeah, it's so interesting that people that are creating these protocols know about this Supreme Court case, and that it's got more mileage again. I mean, because all of the securities lawyers know about it, whether you're issuing debt or you're issuing equity or other different kinds of investment contracts. But to start my blockchain course at Fordham with a case that's Supreme Court cases that the students study is kind of funny in some senses, because they're going over this case, which is, as we know, appears over and over and over in SEC filings and in opinions that, even though we don't just have a few, but opinions of the judges along the way.
The Howey case is about a citrus grower, so that's a good association. It could be something more boring, right? But it's fruit. Yeah. Anyway, you've now created a symposium, you design courses, you've dedicated yourself to try to bring younger minds up to speed on what's exciting from the legal sense. Obviously, you start with the Howey, but what are some of the things that you are now finding yourself kind of focusing on more, maybe past the traditional securities focus, and saying, hey, here are some other things you need to really think about as you look at this space?
Yeah, so I have two courses at Fordham. One is smart contracts and DeFi, and the second one is, well, it was actually the first one first, is blockchain, cryptocurrencies, digital assets. But the content has changed over the, let's say, 2.5 years that I've been teaching, because the markets have changed so much. So I think the first 4 classes are pretty set in the blockchain class, in that we have to go over, most of the students have not studied a securities law yet, and they clearly have no idea what the CFTC is. So the first class, we do much more about what's the regulatory framework in the US, who does what, who's responsible for what, whether it's FinCEN or the SEC or the CFTC, et cetera. And then we move into, we have to do, what is a blockchain? We go through what is Bitcoin and what is ETH. And then by the end of the third class, miraculously, Dow report, which we referred to before, brings everything together that they've learned in the first part. Now, it's pretty fast, and there's a lot of terminology people don't get, and there's so much going on that students bring in what they read on CoinDesk, and we talk about it, even though I say, well, we'll really get to that later. There's a lot of we'll really get to that later. So we do stable coins. We added, of course, the central bank digital currencies, which 2.5 years ago wasn't something we really talked about. I've added DeFi class in the blockchain course. I have more than one in the one that's DeFi. And I also look at asymmetry, of information. So the class that we talk about ICOs, and actually we talk about ICO/Telegram, I contrast that with WeWork. Now, it doesn't sound like it's a natural contrast, but for the S1, meaning the registration statement, for WeWork, the general public would have gotten, all of these high-priced securities that were basically worth an eighth of the amount, if that much. And so that S1 saved the retail client, and because lots and lots of questions started being asked, they saved them from being the basically bad guy for all the institutional investors that were going to get out of WeWork. The same thing if you look at Telegram. That was what the judge was trying to prevent. He was trying to prevent that the retail customer would get all of the high-priced tokens as the institutional investor laid them off on the retail person. There are other intricacies that were involved, but I mean, that's the kind of a way that I like to approach it, so the students get a lot of different information and they get to contrast things together. So it's always evolving. I mean, we took some time in the class to talk about GameStop, even though it was very early in the process of learning, all the terminology, but it was exciting, and it had a lot of the, as we said, themes of crypto in it, but for the 2-day settlement, but for the centralization of the DTCC. So yeah, I think they see that it's exciting, it's timely, and they get fantastic guests that come and talk to the students and, really explain to them the different issues that are evolving in each one of the cases or protocols we look at.
I love the fact that you bring in the WeWork example into the class, because transparency is an issue that exists across all asset classes, particularly in offerings. A lot of the token projects, maybe they don't have the same auditability, the third-party auditability to assess. I think it's a direction that the marketplace goes in terms of code auditability, particularly when you're talking about decentralized organizations. Like, how do you know that if it's decentralized, then somebody has to be, then it's code, right? And also reserves. One of the things that we've seen that's been raised with Tether is this whole issue on reserves, and is there enough visibility? Where do you think we're ultimately going as it relates to transparency of reserves? You mentioned CDCs or these stable coins. How do you see that evolving, and in which directions do you think are the ones that are worth monitoring?
If you had told me that there'd be an $18 billion settlement with Tether, I would have said no way. So I'm not a good forecaster of those things. I do think people look, if blockchain talks about transparency and the ability for us to trust, then it has to provide the mechanisms to do so. And I don't think whether it's a stable coin or a CBDC, it should be any different. People are nervous, I understand that. But the more we know, the less we have to be fearful of. And so to the extent that we can push for more disclosure, in my view, that's always a good thing. And I'd like to be able to see if we can use some of the techniques that are happening in DeFi. So for example, governance tokens, I'm very excited about, and how they could be used in publicly traded companies to improve voting. So I do think that there'll be ways to improve what we have with tools that are happening as central to decentralized protocols. It's just a matter of time and people being less worried about the position, the exact X that they're standing on. Remember, I came from an exchange at a time where everybody stood on the trading floor. And the idea when we were going to do a merger was, the fear wasn't the merger. The fear was that my real estate where I stood on was the most important thing to me, making my livelihood, and therefore I'm scared of the merger. And in fact, what was a real thing to be scared about was that in T+15 there wasn't going to be a trading floor because everything was going to be electronic. So I think that when you look at what you're protecting today, of course it's important to acknowledge that, but it's more important to think about where that could evolve to, and how you're going to create opportunity for yourself or for your firm in order to be able to know where you're going to be in or imagine where you're going to be in T+5 years. So if you look at things as I'm terrified what that's going to do to me right now, then you're going to miss opportunities.
Right. And the governance tokens being overlaid onto traditional companies, meaning where it's not a token offering, where it's security, traditional, that's very intriguing. It's going to be interesting to see how some of these DeFi or governance technologies actually get infused into the current market structure, right?
And Eric, the protocols, the security that's infused with the governance token is not going to worry about that might tip the scales for them being considered to be a security, because they are a security. We're just enhancing the rights of the shareholder and figuring out and knowing, with great certainty. So you don't have, as I think I've been, there was two kind of famous cases. One was Dell and the other was Del Monte, in which you didn't really know at the time of the voting who were the real shareholders. So I think that there's a lot that we can learn, and DeFi has so many smart people in it that we'll be able to learn from. They're smart and they're imaginative and they're doing this all the time, and it's passion and hobby and work and everything together.
So putting aside the valuations or the current money on the table, because that's all in speculative on some level, what are the projects where the underlying technologies, like specific projects, like either governance tokens or otherwise, that you think they're getting it right? Putting aside not investment discussion, just the pure technology direction.
Of course, the big projects like Compound and Aave. I mean, I think I don't know that I can't analyze the tech, but I think that they have great teams and they're working in the right directions to be able to improve not only the protocols, but the access and scalability, et cetera, all the time. So I think they're really good. They're ones that I've spent a little time with because the class looks at them. They look at also all of the goings on that happened with Sushi and Uniswap because they're excited about these kinds of battles back and forth. And it's like epic games for the class, but played out in real life. I'm not the tech person. I look at the holistic approach to it, and I worry only about the exploits that are happening. And so I'm glad when there's not as many retail people in it, because the professionals, they know the risk involved, but that will improve. Is
there anything else that I should be asking you that I haven't asked you, that I've missed, something that'd be particularly interesting to share with the listeners?
I'm just such a fantastically exciting field. When we did the regulatory symposium at Fordham, and when we talked to the dean or students, it touches on so many aspects. Just say the law. That's not to say not the same thing in finance, but in the law, it touches on property, it touches on IP, contracts, of course, AI, and so many other areas that it's not just some body of law that's off on the side, securities law, commodities law, banking, of course, state law comes into it. And so when people in the beginning were saying, what's a crypto lawyer, or which is the same thing like saying, what's a crypto finance person? You still have to know finance. So you're building on a skill sets that you've already have or that you can develop. And I think it's exciting for people that are in their careers already and people that are going to school, because there's so many opportunities and we see them blossoming right before our eyes. We wouldn't have been talking about the explosion of marketplaces and NFTs and all of those intricacies. Even 6 months ago, it wasn't the same. We were talking about in June the rapid development of the DeFi and governance tokens, right?
Right. And it's always changing. It's always new terms to keep up on top of.
So much reading.
Yeah, it is. And it's this proverbial rabbit hole. You have to make a decision. Either you're diving in or you're not. And if you're not, you're going to be watching it and saying, what is going on? But Donna, I'm so glad that you were able to join the podcast. It was great having you.
Thank you so much. It's a pleasure to be here, and enjoy your weekend. Be safe. And next year, hopefully we'll be able to do all these kinds of things in person and welcome many people to the stage.
Great. Thanks so much.
Bye-bye.